We will go ahead and get started with today's demo. We just got started with the recording. Once again, this is Brian Wilson from Market Structure Edge. I'm thrilled that you can join me today. A lot to unpack here. There's obviously a lot going on in the market right now. So we'll go ahead and get started. We'll get started in a somewhat unusual manner. I'm going to take you back to actually GameStop back in 2020. I had it up on my computer, so I wanted to show that to you before we got into other information. So once again, welcome. We'll go ahead and get started. Oh, I should just mention one item. Feel free to send any questions in the chat as you have them. Happy to address those as we proceed today. I'll try to cover one or two topics at a time and then kind of circle back to everyone to see if any questions come into the chat room. I won't be able to see them when I'm doing the discussion itself. So we'll go ahead and get into it here. Once again, we're going back to kind of a strange place. That's GameStop back in 2020, but there's a reason here to my madness. So this is what GameStop looked like back in 2020. This was the gains that we saw at that particular time. Shares moving from $5, all the way up to where did they move it at one point? All the way up to over $80 at one point. So just an extreme meme stock. There were meme stock. There were a few of them, but I wanted to share with you what happened during that craze. Note where short volume was really at the beginning of the craze. It was very low, down at about 34%. And as that craze continued, notice what happened to short volume. It was rising throughout that period. You had Tim mention this a couple of days ago. The reason that shares were able to do this, it was because of manufactured shares. So in other words, it was trading many times its float during the course of those trading days, and market participants were borrowing shares to facilitate that trading. That's why short volume was rising. And I had a question from a market participant earlier about higher short volumes and then lower short volumes. I've been doing this job for a little over 9 years, going on 10 years. The central tendency is those that are short shares would rather cover at lower prices. Look at what happened here. Notice when shorts got covered, it was at lower prices. And historically, we'll see this over and over again. Those that are short shares actually have about 30 days to cover those short positions. They have an economic incentive, if possible, to cover at lower prices. There's GameStop. That's exactly what happened at that particular time. I'm going to take you over for a moment to a Modern IR slide deck. So we have two companies, Modern IR and Market Structure Edge. This is related to short volume itself, and I thought it might be helpful just as a little bit of a refresher. I know the concepts can sometimes be a little bit confusing. So short volume itself is a reference of trading from borrowed shares. So one way that you can think about it is for every 100 shares that comes to market to buy, historically about 50 of those shares will be filled by a seller who has borrowed or located the shares. Once again, the S&P 500 average is about 50%. So who are the participants who are borrowing shares? Well, it can be traditional shorting. That would be market participants who believe that share price, will decline. That would be more of the short interest, which, by the way, is about 3% of trading on a normal basis. You also have market makers in there. You also have, to a certain extent, ETF brokers. And that in essence is the way that you can think about short volume. Think of it as borrowed shares. So why am I starting the discussion with short volume? Essentially, we have had a meme stock effect throughout the broad market. And you can see when it started right here. What was this date? Well, we were coming out of options expirations, and I think there was an opportunity across the market. The opportunity was inexpensive rights to shares. Once again, we're coming out of expirations. Market participants are looking ahead to the next series of options, and we just get the broad market that just rips higher. As the market starts to move higher, what happens at the same time? Well, short volume starts to move higher. In fact, right now it is at historic highs. Why did short volume follow this trajectory higher? Because there was such excessive demand for shares that shares were being borrowed to facilitate this demand. It's like what I just showed you with GameStop, just on a broad market level. What was happening right around this time? Well, I mentioned the broad market already. Look at the S&P 500. This was activity coming through expirations. We have the declines in the broad market, and once again, we have that market ripping higher. And I think to a certain extent, it was due to big tech. So if we look at what was happening with big tech right around the same time frame here, big tech sentiment slipping, moving below neutral. Is big tech going to continue to move down? Is the market going to have some heavy damage? No, demand came back strong. It came back strong right ahead of a series of earnings prints. Microsoft was one of them. There were others during that time frame. Demand gets all the way up to 9.7, and you can see the accompanied movement in the market. And once again, big tech is about 30% of the weighting for the S&P 500. That's part of the reason that we, closely follow, what's happening there. So once again, short volume, I think there's a reason why short volume has moved in the manner that it has. I think it's facilitated this move higher in the market over the last couple of weeks. I did want to speak into one topic here for a moment, and let me stop sharing, see if we have any questions that I've missed. Anesh, could you clarify what you mean by that on behavior, and we can come back to your question there in just a moment. I'm not quite sure what you mean by that. And once again, if you have any questions, feel free. Passive. Are you referencing what I was looking at for short volume? Is that the reference? And you can feel free to put your mic on if you want to. And once again, we can circle back to that. I think your question is in regards to that short volume versus short interest slide that I was.
Can you hear me?
Yes, I can.
Okay. No, I was talking about the leading behavior you have on the dashboard.
Sure. Yeah. In terms of what's been happening recently in the market.
Yeah, there are also the different types of behavior, I guess. If you have a slide like you were showing on short interest or short volume.
Yeah. Let me see if I can find that real quick. Bear with me for 1 second here. Hopefully this addresses your question. And I'll share this in two different ways. One is kind of a broad market view, and then I'll show you what has been happening during the last 3 weeks or so. So this is the broad market view. This is historically what has happened in the market. This is the market that I was used to. I'm a former buy side trader, where most of the market movement was occurring because of what active investors were doing in the marketplace. This is the market that we have today. It's like waking up on a different planet. It's part of why market structure is so important. We have executive teams all the time. We're right in the middle of earnings season, so we're doing a lot of earnings work for a lot of clients. And they still believe that, their stock is down or up because active investors are moving in the market. It's just not the reality of how the market works right now. The market, active money, about 10% of the time, those that's those that are caring about the actual stock story. Fast trading, which is high frequency trading strategies. It's also market makers. Passive money, index funds, ETFs, quant funds, about 22% of daily trading. And then risk management is a huge component. It's why you hear us talking about options expirations, because you can and do see strategies and tactics that will change around expirations itself. So 4 different behaviors, moving in the market. What did we see when we saw the market really start to rally over the course of the last few days? Let me enlarge this last couple of weeks. This is an S&P 500 report. It's one that we use for our investor relations clients. But notice what happened really from the 21st going forward. That was the last day that we saw weakness in the market. What you're looking at here is the 4 different behaviors, and we're looking for behaviors that are above the 0 axis. That means greater influence from those particular behaviors. So as the market rallied from the 21st going forward, what behaviors do we see in the market? We see some active money. We see a lot of passive money, a lot of quantitative strategies. We had ETFs really coming into the market, a lot of ETF flows, probably a lot of quantitative hedge funds as well. And we're getting active money that's coming back now into the market as well. So for the most part, this rally's been very investor driven. And once again, we're talking over the course of the last 2.5 weeks or so. Hopefully that addressed your question there, Anash. Brad, are day traders considered fast trading? Absolutely. Moving in and out during the course of a trading day. Actually, retail trading would be caught up in that crowd as well. The reason for that is because the brokers have bought out those retail traders. So the fast traders have bought out that retail trading order flow. So if it is retail traders that are in the middle of a stock market rally or decline, that's going to show up as a fast trading behavior. Kind of talked about short volume so far, and please continue to hit me with additional questions. Happy to address them as they come up. I want to go to what I described earlier with, and to your question, Mike. No one wants to sell except the market makers. It depends, Mike. You will get natural selling, but it makes up about 50% of trading on average. So there isn't as much natural selling in the marketplace. And what that means is that trades get splintered over time, where average trade size just continues to move lower and lower. Who profits when average trade size is lower? It's fast traders or the machines. They don't have to put as much capital at risk, if that makes sense. So about 50% of trading, when there are buyers in the marketplace, about 50% is coming from natural sellers, about 50% coming from borrowed shares. I wanted to go to what we're seeing with this. So this is what we call a double sentiment top, and it doesn't happen very often. I'll move the look back about a year or so. This is the natural rhythm of the market. So the market moves higher, it moves above the red line, it moves lower again, and back and forth we go. If you look at given securities, you'll see the same rhythm occurring in different securities. The way to think about that, there's greater demand in the marketplace, demand fades, there's greater demand fades. So the market goes through these cycles. But what you're seeing here is that you'll have a top and then the market will move lower again. You don't tend to have a top and then the top extends. Well, that's actually what we're seeing here. We're getting this double sentiment top. It's only occurred by my reckoning 5 times in the market data. So this goes back to 2017. I'll quickly take you through these instances. And you'll see for the most part, when we have these double sentiment tops, it means that there's been such excessive demand in the marketplace that it continues to carry the market for a little further. Not all the time, but most of the time. So this was January 2018. You can see that double sentiment top forming. This was one of the times where the market actually fell afterwards. And this was about an 8% drop in the marketplace coming after a double top. April 2020, this was an outlier. We were just coming out of the pandemic. The market just ripped higher afterwards, but of course the Fed intervened. I'm not even sure if we can count that one as normal trading. You can if you want to. If you do, it just means that the market was moving higher afterwards, and there was really no stop in terms of that market moving higher. This is more normal. The next 2 slides are kind of more normal activity. Most recently, July 2023, you can see we formed this double sentiment top right around expirations. The market continues to have a little bit of upside afterwards. When does it end? Well, it ends at an inflection point, which in this case was month end. March 2024, very similar trading. We have a double sentiment top. Once again, this was right around expirations. The market continued to move a little higher until we got to month end, and then the market gains kind of flattened out. So that's it historically. Only 4 times before this year, and right now, right in the middle of a sentiment top, double sentiment top, and also short volumes that are at historic highs. So what we're talking about here are outliers. We're talking about outliers from a short volume perspective. We're talking about outliers in terms of sentiment as well. So we are tracking through extreme outliers at this particular time. Rich, to your question, what will I do with a stock that is removed from the list the very next day? I will usually hold that for a little while, Rich. The reason being is that if it was, let's say, in a momentum stock, it still has really good, strong demand. And most of the time you don't see those just decaying immediately. I'll keep a close eye on it, but I'll usually keep it in my portfolio, with those same stops in place. So that hopefully that helps to address that question. Let me tackle what's next here. Going just a few different places today. We're at an unusual time right now. So I wanted to kind of take us through, what we're seeing in the data. Obviously, we have this double top. We have short volumes, which are outliers. We also have the SPY, which is an outlier right now as well. So this is a slide deck that I shared previously. We'll kind of just walk through this briefly for those that have not seen it before. looking at SPY sentiment trends over time. So SPY is the only ETF that we track. We try not to track very many ETFs because it just kind of muddies the water in terms of sentiment and short volume, and we don't want to do that. 2018 SPY market comes under a little bit of pressure when sentiment hits one. The way that you can think about sentiment hitting one is every demand's just falling off. Everything's been washed out. And you can see sentiment hitting one 3 different times during 2018, returns of about -6% for the market. By the way, SPY sentiment tends to be at 5 on a normal basis. That's the norms for the SPY. Why is that? Because everything tends to move towards blended products. Large cap blend is basically the largest one in the market itself. Just that blend between growth and value, and over time, it tends to present itself with sentiment being at neutral. 2022, very different story. Look at the movement in SPY over the course of that year. It was much more noticeable than 2018. Sentiment getting washed out all the time. Not only was sentiment moving to 1 all the time, sentiment was sharply moving to 10 repeatedly. These are bear market moves in the middle of a bear market. You can see it here. You can have sharp moves higher, but then that bear market continues afterwards. You get a sharp move higher, the bear market continues, and back and forth you go. It's a battle in that type of market. 2 takeaways from this slide: you're hitting 1 repeatedly, you're hitting 10 repeatedly. Look at the bull market in 2023. Once again, we're at neutral almost all the time. That's the normal condition for the broad market. We only hit 10 once during the course of the year. We never hit 1. 2024, identical. We only hit 10 once during the course of the year. We never hit 1. And what do we have so far this year? It's an incomplete look, obviously, but we're 4 months into the year. We've already hit sentiment of a 1 reading 2 different times. We've already hit a 10 reading 1 time. So are we in a bull market? Are we in a bear market? Or are we in a correction market? Hard to say, but so far it doesn't look very much like 2023 or 2024, does it? Hard to say which one of these, which one of the other ones it might be, but you can see that it doesn't reflect, bull market conditions at this particular time. Let me stop sharing the screen for a second, see if we have any questions Candace, good question. Bear market is usually identified as being down 20%. And I call a correction market just moving lower during the course of the year. So that's the typical definition of a bear market, down 20% during the course of the year. Let me go to the next slide I wanted to share with you. And this has to do with where we are in terms of overall volatility. And once again, this is a slide deck that I've shared with you before, but kind of rehearsing this, and I added a few numbers to the mix just to see if that would be helpful or not. 2018, we saw declines towards the end of the year. Recovery came when shorts were covered, and then we had that move higher in terms of sentiment. And this is kind of interesting. Certain parallels to right now. It's always hard to say we're in this market or we're in that market. We can just present what's happened in the past. And then try to figure out where we might be. But what we saw here, we did see short covering, and then somewhat like we've seen recently, we saw real increase in short volume, and we saw sentiment really rising. 2020, what we saw in that market, well, we saw the market obviously moving lower, but we saw before recovery happened, we saw a sharp decline in terms of overall short volume. 2022, I think market participants got spooked finally during that year. The market had been moving lower for so long that we see a little bit. I think of that market once again being spooked. It went up 15%, and then we finally got some short covering, sentiment rises, and the market went off to the races. This next slide, I don't know if it has parallels or not. I was just trying to compare 2022 trading to 2025. Once again, I don't know if this is applicable or not, but I'll just share it with you. As the market started to move lower in the first part of 2022, we had movement from very low short volumes to fairly high short volumes. That was a 15% increase. We didn't catch relief though until we ultimately went 25% higher from lows to highs. Now, once again, I don't know if this is a valid comparison or not. I'll just share it with you for what we're seeing in the data. So far this year, we have about a 21% increase from lows to highs. Of course, we talked about that meme stock effect, and that might be in play why we're seeing these higher short volumes right now. In terms of where we're at right now, once again, this is the double sentiment top that we're in the middle of. And we did see very limited short covering during the past month or so. And we've seen that those short volumes increase now over time. And once again, from a short volume perspective, and I'll move back to the broad market look for a moment, those that are short the market would rather cover at lower prices. It's just the way that trading works out. If you look through here, when market had been kind of moving higher, where do shorts get covered? Well, they kind of get covered when short volumes are lower. The market moves higher. Where do shorts get covered? They try to cover them when the market moves lower. You can really see it down through here. We're getting that short covering at lower prices. So it's just an economic incentive that's out there. Market participants would rather cover at those lower price points. And I'll stop sharing for a second, see if any other questions have come in. Brad, to your question about how market structure sentiment is determined, we look at the 4 different behaviors that are in play, and we're looking at the impact that each one has on pricing. So it's basically like a weighted average. So fast traders would make up about 50, this is normal trading, fast traders would make up about 50% of that weighted average. Active money would make up about 10%, and it's looking at week over week activity in terms of how that is calculated. So just think of it as a weighted average with the machines, with the behaviors that have a greater impact on pricing. They're going to have a greater impact on that overall sentiment score. See where we're at in terms of broad market. We'll circle back to kind of the broad market look and this aspect of strong demand. And strong demand has taken us through 2 potential really tipping points. And what I mean by tipping points is we moved higher with strong sentiment. We came up to month end. And if you look recently at different month ends, they were inflection points. Here was March month end. What happened to the broad market afterward? The broad market slipped. Here was April month end. What happened afterwards? The market slipped. So we came over the red line which is indicative of stretched conditions for the broad market. In other words, the market's firing on all cylinders. We come up to a potential inflection point, and so far, we've been able to continue to kind of move higher past that inflection point. That was a potential turning point for the market. Why was that? Well, because we were stretched from a sentiment perspective, and short volumes had been rising in the background. Uh, we continued obviously moving higher from that point, so the market rally has continued. We moved past another inflection point just yesterday with the FOMC decision. That was one where we could have seen some volatility and maybe the market moving lower, and it for now it did not move lower after that inflection point. That brings us up to the next inflection point, which will be next Thursday and Friday. That'll be options expirations. Once we get past that point, you'll see them manifest here on the chart itself. But why is expirations an inflection point? Because strategies and tactics can change when we get to expirations. You have about 20% of market cap. Once again, I'll take you back to this slide. 18 to 20% in general terms. That's looking at some types of derivatives strategies, whether they're leveraging into equities, whether they're trying to protect their positions. And as we come up to expirations, they have to make decisions regarding those strategies. For example, have call contracts become too expensive? Well, there's going to be a price attached to that as they roll over those call contracts. Did they make a lot of money on a leveraged trade and they just want to cash in that trade? So all these decisions are being made behind the scenes as we come up to expirations, and once again, that will be next Thursday and Friday. So we've kind of come through one potential inflection point here at month end. You can see once again, the last two times it did not manifest in weakness this time, or did manifest in weakness the previous two times. It did not manifest that way this time. We made it through the FOMC decision. To me, we're coming up on the next potential inflection point, which would be options expirations next week. I will share one other data point with you. I shared this with everyone last time. What you're looking at here, this is just a spreadsheet that I keep, and it's quite simply sentiment above 6. What that is sentiment above the red line. So what the exercise is trying to do is look at historic returns. When we're above that red line, when the market gets stretched, what does the market tend to perform over time? So every time it goes above the red line, how long does it tend to stay there? What's the average market performance? And looking back over time, and this is looking at data from January 2020, all the way going through, I believe it was September of 2024. Obviously, the more data points you have, it's going to average things out over time. But that average performance over that time frame, 50 basis points. How long do we tend to stay above the red line? Well, we tend to stay above it about 9 days. What are the big outliers? Obviously, we're in the middle of a double top right now. What have we seen with some of the outliers in the past? Let me take you to a couple of those outliers. So back in November 2020, coming out of the pandemic, we were above that red line for 25 days, 5% performance during that time. Right at the very beginning of the pandemic, we were above it for 17 days, 15% performance. Obviously these are extremes in the data. And then a bear market example back in July 2022. If you remember that slide that I showed you, sometimes you can get those violent swings during bear markets. I think this is one of those examples. We're above the red line for 24 days, returns of about 4%. But in general terms, market returns kind of get washed out once we get above that red line. Just think of it as overbought or stretched conditions. Once again, those returns are about 50 basis points. What do I see? And let me stop for a second, see if any other questions came in. Max, daily trading ideas, is there real-time info? It's updated every night. So I believe it's either 1 a.m. or 2 a.m. Mountain Time when we have that access to the data. How do you know when its move is done? Well, it'll fall out of the daily trading ideas. We addressed that question earlier. When I'm already in a name, I'll just keep it, but I'll make sure to have my stop loss in play. Perhaps leaving money on the table. One way that I've been addressing that, Max, is I'll set half of my position. So in other words, I did this with a name a couple of days ago. I got into the name and I took half of my position with 2% gains to the upside. And then I tried to let the other half of the position run, if that makes sense. So you're kind of playing with the bank's money at that point. Does it work? It works enough of the time to make it worth make it worth the hassle for me, and it's not too much of a hassle. I just have it on a watch list, and I know I've already made my 2% on half of the trade. And if it's one of those days where the market is really running, let me give you an example. Let's say that you were fortunate enough to get into, I think that's Carvana. If you were fortunate enough to get into that one, and you had your 2% gains for half of your position, well, you're making huge gains on the other half of your position. So that's one way that you can potentially address that. Hopefully that addressed that question. We talked about sentiment being above 6. Where are we right now? Yes, scale outs slowly, leave a runner. Yep, you're exactly right. Where are we now? We're at outliers. There's no other way of saying it. If Tim was on the call today, he would quote Stein's law. Mr. Stein was an economist, and his law went something like this: if something cannot go on forever, it will stop. So what cannot go on forever? Well, sentiment above the red line cannot go on forever, especially when we're in the middle of a double sentiment top. Short volume at historic highs cannot go on forever. At some point, those shorts need to get covered. What's the next potential inflection point where we could see such activity? Well, that would be options expirations next week. Could we get continued gains into expirations? It's certainly a distinct possibility. Think about where market participants might be at right now. If they picked up inexpensive rights to shares here and they've been holding them throughout this run, they might very well hold them, hoping that we get continued gains into expirations next week. So sometimes what I'll do is I'll try to think through that exercise. Are market participants holding on to something that's worth something right now? And the answer to that right now, I think, is yes. But we also know that we're coming up on that inflection point next week. We're very, very stretched from a sentiment perspective. We're very stretched from a short volume perspective. Do I expect the market to just collapse right now? No, I don't. We look at some of these double tops that we've seen from a sentiment perspective. This is the only one historically where we had issues, and that one moved down 8%. The other ones that we've seen, kind of continued gains once again until we came to that inflection point, and then we started to see declines afterwards. But even then, they weren't, extremely sharp declines. And there was that other example. How am I addressing this market right now? Well, I'm working. I'm continuing to buy the daily trading ideas. I made money on two of them today. I was actually able to make money on one other idea today as well. It was VRNA. This name was down 5% earlier in the trading session. I was taking a look at it, and if you look at the daily trading ideas, you can see the volatility in given names. Let me try to find that one again. Here it is. So the last 5 days, daily volatility of about 4%. So it had lost all of its volatility and it was down another 1% besides that. I'm not going to buy the name if there's news in the name. I did not see any news. I bought about a 3/4 position, made about 2% and got out. I'm thrilled with those types of gains. So I'm continuing to pursue names in the daily trading ideas. I bought QFIN yesterday. Once again, I bought VRNA on an intraday trade today. In terms of positions like SPXU, that's 2x leverage to the downside. SPXL, 2x leverage to the upside. It's a difficult market right now for directional trades. It just really is. Why is that? We're not getting any clear signs. A clear sign higher would be in here, where we're moving higher between the green and red lines and short volumes are low. That's a great place for a directional trade. That type of directional trade, can last a few days, maybe a week, maybe a week and a half. You have to recognize that all of these signals in the market are very short-term oriented because that's the way the market is dictated. Once you get above the red line, it becomes much more difficult for directional trades. If anything, maybe we continue to have a little bit of upside into expirations, as I already mentioned, but I'm not placing any directional trades for the time being. So I'll stop there. Any other questions? I think that's the main things that I wanted to cover. We are once again at extreme outliers in the data right now. Could we continue to see upside into next week? Yes, I think we could, but just recognize the market for what it is. We're in the middle of an outlier from a double sentiment top and very high short volumes, and it makes it a very challenging market. So just be careful out there. Happy to address any questions that you may have. Please hit me up on the email or hit Tim up on the email. Thank you very much for your time today. I really appreciate it.